Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 15th of December. I'm Daniel Lam, your host for the podcast. 2025 has been an extremely eventful year. Now, being a keen movie watcher, I was upset that one of my favorite actors, Val Kilmer, passed away earlier this year. I watched one of his movies again, called Heat. That movie was famous because two of the giants in modern cinematic history, Al Pacino and Robert DeNiro, shared a 5-minute scene together. Was the movie screen big enough for the two of them? Now, one of the key recommendations we made in our 2026 annual outlook was upgrading Indian equities to an overweight within the Asia ex-Japan region, as well as having India large and mid-cap as an opportunistic idea. However, at the same time, we are maintaining an overweight on Chinese equities within Asia. Now, given the sheer size of both markets, the question is, can both China and India outperform Asia ex-Japan simultaneously? We believe the answer is a yes. Firstly, we're expecting both markets to be positively correlated. It is true that, in the past, MSCI China and MSCI India have been negatively correlated for significant lengths of time. However, in the past year, this correlation has turned positive. In fact, India and Chinese equities had simultaneously outperformed their regional peers over a 6-month period, 20% of the time since the year 2000, based on monthly data. Secondly, the two markets offer very different types of equity exposure. Indian equities offer premium growth, while Chinese equities have attractive valuations. So Indian equities are supported by a high return on equity. India also remains one of the fastest growing emerging markets, with the third quarter GDP growth reaching 8.2% year over year. We're expecting Indian companies to deliver high 12-month forward EPS growth at 15.5%. Now, in contrast, China's government is likely to set a 5% growth target for the year of 2026, despite the recent slowdown. So this implies a still high expected 12-month forward EPS growth of 10.5%, but Chinese equities are trading at a 44% discount to Indian equities, based on 12-month forward PE. Structural reforms, they are helping both markets. Indian policymakers have taken steps to simplify the national GST structure and ease compliance regulations to attract foreign investors. Meanwhile, growth stocks support Chinese equity performance, reinforced by policy initiatives such as AI investments and measures to boost consumption. Finally, geopolitical considerations are important. US tariff policy is a risk for both markets, and any trade agreements with the US could bolster sentiment and trigger valuation re-rating. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.